What's up, YouTube? It's Todd Horst here with Taste Tracker, and today I wanted to talk about drawdowns, and so let's jump right into it. Get my head down. Okay, so every style of trade has its periods of drawdowns. There is absolutely no way to get around that. Doesn't matter what you're doing. You could be trading pennies. You could be doing what I'm doing largely, which is put credit spreads. You could be buying calls. You can just be buying shares, and you could be shorting. Doesn't matter. Absolutely doesn't matter. You will have periods of drawdowns, whether that's because of the market not cooperating with what you want to do, or that's because you have a string of bad trades. Maybe you're day trading and you're feeling off that week. Whatever the case is, each style has a drawdown. And so over here on the side here, I have a chart of one of my accounts. This is the my IRA account. And so we can see here, I'm slowly climbing in February, and then I have a substantial drop. And then we can see it, building back up there. And then since third quarter last year, I've just kind of been in this sideways chop. At the very beginning of the year, I had another, significant move up. And then we got into the correction for the past couple of weeks. And I realized that what is important to me here is this light trend line and the direction it's going. If it's going up, I don't necessarily care about all of these little gyrations. Sometimes with especially my style of trade, because I'm doing longer dated swing trades, usually 45 days is what I target, and I typically get out around 20 days. But because it's longer dated, a lot of the time these drawdowns in here and in here are actually paper losses. They're not actual losses. Of course, sometimes you might have a little bit of loss where one position expired at the wrong time, or you had to pay to roll or whatever. And so obviously I'm incurring losses, but the large majority of this is just my account value dropping, not necessarily but even if you were day trading stocks, you would see these dips where you had a bad day, and then you would make it back up. So you get these drops when the market doesn't align with what your expectations are, and that's really, really, really critical if you're day trading. If the long-term trend is up and the day is up, and so you're playing bullish plays on your day trades, but for whatever reason that's the beginning of a correction, or maybe you chose the wrong ticker or whatever, that's going to obviously affect it. Maybe you're not implementing your strategy correctly. Whatever. There could be several reasons. But, second bullet point here is that it's our job to remain calm, understand the nature of the drawdown. So that's probably, half of my mental exercise when we get into situations like this is, what is causing this, and is it a short-term dip or is it a long-term dip? Back with the COVID, I thought it would not last as long as nearly as long as what people were expecting. I thought maybe in 6 to 9 months. So I thought maybe by September of last year, the ramifications would be much less than what people anticipated. Now, I was definitely wrong to a degree. We're still battling issues related to that, whether you're talking about the economy or just your everyday lives. But I was more right than I was wrong, in the sense that there is a vaccine now. I've gotten it, and there's a light at the end of the tunnel. So the first gut reaction when anything like that pops up is people are going to get scared and just cash out. And that's actually, depending on how soon you're able to do it, not always the bad thing. If you would have gotten out at the beginning of the COVID crash, you would have saved yourself a lot of money, and you could have re-entered potentially at the bottom. Of course, that deals with timing the market, which is obviously hard to do. But let's get back on topic here. My job is to sort of assess what the causes are and what duration I think those causes will have on the market. And then the last point is to get back to work. If you're doing this for fun, that's cool. My personal my goal, my strategy is to be doing this for the rest of my life. So if your goal is to just make a couple bucks here or there and not really get into it, that's fine. But a drawdown is going to be more likely to knock you out, whether you can take it emotionally or whatever. But if you have the mindset that I'm going to be doing this for the rest of my life, and I'm not going to going to blow up my account, and I'm going to do what it takes to year over year increase the value of my account, then I think that makes it easier to understand and make it through the tough times of trading. So a couple questions I think you need to ask yourself is, has this method worked for you in the past? And has it been consistent? And has it been consistent working for you for a decent period of time? So if you're just getting started, this is obviously hard to answer. But that first, obviously, you need to find your strategy. But if you, with the assumption that you found it and you've been implementing that for a year or two or three or four or five, and then you hit a crash, then to me, I see a lot of people panicking and they want to throw out all of their experience, all of their knowledge, and they get frantic, which is crazy. If you've been trading a strategy that long, then you should know that, this is part of the game. If this is the case, I think I get into it in the next slide. Let me move on. Has something fundamentally changed about the market? And I would say this actually happens more than what people give it credit for. They compare charts over the last 100 years. Well, today's environment is so different than 100 years ago, whether you're talking about technology or the efficiency in which we trade, whatever. There are so many differences that it's hard to draw too much analysis, put too much weight on that from the past to apply that to the future. Because things are continuing to evolve. So quantitative easing is a huge thing. Did something about that change? Our interest rates are a little bit, they've always been around. So it's not something that's as high on my list of, yes, an interest rate that will go up and down. But I don't see that as like a fundamental change. So banking regulation, with the housing collapse, etc., that puts a huge persistent change in the market. And then maybe you're worried about a collapse from debt, as we incur more debt to do these bailouts. Maybe that's a concern. You have to realistically analyze those things and think if that's fundamentally changed going forward the way the market behaves. Then maybe you would change your strategy. The last bullet point I have here is, are you deviating from what was profitable? So, I mean, obviously, as you're not a robot, and even if you are a robot, I don't necessarily think that's the solution. Trading bots. So we're not perfect. So we're going to enter in positions at different times. Maybe we didn't see the setup, or maybe we're just trying to try out new strategies. Maybe we're trying to use our strategy in different situations that are untested. So we take a method that's worked in scenario A, try to apply that to B, and sometimes that works. Sometimes you need to modify it slightly or completely overhaul it to work in different scenarios. So, the point is, have you changed what made you profitable in the past? And so let's just go into the next slide where I talk about resolution. So if it's worked for you in the past, odds are that it will work again when the market's ready. So, it's not necessarily you that's doing something wrong. It's just that the setups aren't there, or the underlying fundamentals maybe in the sector that you like to trade, or the types, maybe you're into ETFs or specific stocks, etc. If it's worked in the past, it's probably going to work again in the future, but you just might need to give it a breather for a month or 3 months until you can get back into a situation that it's worked before. And again, I'm speaking about sort of long-term consistent strategies. There are other strategies that you might implement in a correction phase of the market, which typically speaking is going to be measured in weeks as opposed to years. Sometimes they can get into years, obviously, but I consider those more of a crash. But anyway, when the market's hot, maybe you took more risks, so now you need to get back to basics and stick with what made you successful so far. Talked about that a little bit on the previous slide, but too much deviation. It's good to explore other areas that you can apply your strategy, see what other edges you have in the market, expand your experience so that you can get good at different things, so that you have different backup plans. Basically, like if I know I can trade these 5 styles of trade and 1 and 2 aren't working, but maybe 3 and 4 are working just fine in this certain setup, it just gives you you're a more robust trader, basically. Okay, so maybe you just got too crazy, you were trying out new stuff, and in a correction mode or a drawdown, you need to get back to basics, put all of the experimentation on hold, and focus on getting your account back to where it should be. And generally speaking, going forward, after you get back to where your account was, I do think you should play with a certain portion of your account, but it needs to be an appropriate size where it's not negatively impacting your account. If you're having a drawdown because you're experimenting too hard, you need to only play with 2% of your account or 1% of your account or something like that, just to test something out and do one experiment at a time in a sequence of experiments, as opposed to I'm going to experiment with 10 different things here all at once on one expiration. So maybe that's a different topic. I don't know. Third bullet point here is keep patient and move slower. So over the past weeks, you've seen my tweets dramatically decrease, the amount of charting I do decrease, the amount of positions I put on decrease, the amount of positions I roll increase by a large percentage, but I'm typically not doing them all in one day. There was one day there where I had to quickly adjust to get out of a bunch of positions to make sure I was safe. But typically I'm doing things as slowly as possible because I don't know how far down the market's going to continue to go or when the market's going to bounce back up, what sectors are going to be impacted. Is there rotation in the sectors, which there has been these past weeks. That's why SPY is now back to all-time highs, but tech is not following, at least not where it was. So the whole point here is to move slower so that you don't have the pendulum swing too far the other way. So if the second that the market starts going down, you sell all of your positions, then you open up all new bearish positions, and then 2 days later it bounces right back to where it was, now your account just blew up. So you need to slowly peel those positions off one by one, slowly start adding some neutral positions, maybe some iron condors, or just buying long stock ETFs or companies that are getting cheaper that you like, just to bide you some time. I like cash secured puts during downturns because if they're in companies I believe in, then they're only going to go down so far anyway. And even if they did and I got assigned, I'm okay holding them, etc. So there's a lot of different strategies there. So if you're trying to make up what you lost in a day, back in a day, okay, let me start that sentence again. If you're trying to make back what you lost in a day, make that back in a day, you're obviously just going to lose more. You can't totally gamble, and in most cases, not all the time, but in a lot of cases, you'll lose much quicker than you can gain. So if you're trying to do some wild bet, get into something insanely risky that has zero chance of success, it's cheap for a reason. You bought that long call that's basically going to expire worthless. But if you really, really push hard just to try to compensate for the loss that you just had, you're going to lose more and take even longer to get back up to break even. So it definitely takes longer to build it than to burn it. And remember how long it took you to get to that spot to begin with. So, your account was, way up here, and that's taken you many months to get up there. And so now if you drop back to where you were last September, it's going to take potentially 3 months to get back to where you were just before the market went down here. So that stinks. Obviously, nobody likes hearing that, but the reality is that that's a potential. It may not be that way. If you get a healthy bounce and you're able to close out of some of those positions that were very far in the money, and for short positions we want them to get out of the money, they'll get value back in them very quickly if we can get a good bounce. So anyway, last bullet point here. If the market has changed, obviously we're considering if that invalidates your strategy altogether. Typically it's not going to. There's might be a small tweak here or there. Again, and the market change, I'm not talking about a bull market or a bear market. I'm talking about something fundamental that has changed life as we know it, the markets especially as we know it. More than likely, you're just going to need to tweak or wait for better setups or for the time to occur where that strategy is relevant again. So again, you might have to take a 3-month breather on that particular setup that you're not going to see because things are sorting themselves out or whatever. Okay, so that's really all I wanted to talk about today. I do have broker links in the description, do all the YouTube stuff. Twitter, I post charts there almost daily, less recently, but I will get back to that as soon as the market picks up again. Discord, we're chatting basically all day. My site's free. You can track your own trades. I do have pro alerts, but that's not, you don't need to do that for sure. And anyway, all of this is just my opinion, and let me know if you have any questions in the comments below. Thanks.